Australian Wealth Builders, helping time-poor executives build financial independence through property investing.
Welcome back. Thanks for joining us. I'm Cam McLellan, one of the directors at OpenCorp. I've got my business partner, Matt Lewison, who is also a director of OpenCorp and the managing director of Resi Fund. Matt, how are you?
Good, Cam. Good to catch up again.
Yeah, likewise. You're up in Brizzy. You've made the move up out of Melbourne, one of the people who's left Mexico behind and gone north.
I've been telling people I'm not one of the COVID evacuees.
You pre-planned
it. Planning the move to Queensland for a while.
Yeah, and Claire, your wife's obviously from Brisbane originally, and you spent 5 years up there in your working career, isn't it?
Yeah, and then touch more, but yeah, it was good times. Love it up here, and it's good to be back.
Yeah, it is probably one of the other, I'd say, besides Melbourne, New York or Brisbane would be my two cities that I could comprehend living in. So
yeah, and they're very similar, New York and Brisbane, aren't they?
They are very much so. Very much so. We've got some good topics to go through today, Matt. I'm going to quiz you on a number of these, but I want to nail off how much income you need to build a property portfolio. Is investing just for the rich? Because a lot of people have that concept that you need money to make money. How much you need to get started? Will buying an investment property impact your lifestyle? Because I think this is when there's people investing in property, there's usually that driver of the person who really wants to do it and the passenger. And it starts out that way. So ensuring that both people come along for the journey is important. And usually for the passenger, how's my lifestyle going to be impacted is one of the key questions we get asked. And then we get a lot of people asking, they haven't got quite enough for a deposit. I know Resi Fund's one thing I want to talk about, but if someone's only got $10,000, what should they do with it? What are the options they should do with it? And how do they take it from there to being able to get it to the point of being a deposit on a property, or at least ensuring they're in the market?
Yep.
So if I roll back, Louis, obviously you work with our acquisitions team, and part of that is working through finance approvals with the banks and ensuring our investment consultants are creating a good enough financial snapshot, allowing enough buffers for people when they're buying investments. But investing is not just for the rich, because we see those people coming through. Their aim is to be rich, but how much do you need to build a property portfolio? What's the entry level for most people in a good buying market?
Yeah, so it's interesting, isn't it? Because it comes into that cash flow question, and also how's it going to affect your lifestyle? We tend to say 75 grand plus will give you, I guess, access to the property market, an income of 75,000. Also depends what your expenditure is. Obviously, the more you spend, the higher that goes. But also it comes down to what type of property you're buying. There are properties around Australia that might have good growth potential and cost a lot more to hold because the median price for that suburb might be higher relative to the median rent. And there are some suburbs where they're yielding over 5%, which means that they're cash flow positive on the day you buy them and putting money into your pocket. And obviously those decisions, and depends on your plan and what you're trying to achieve and what your income is to start with, a huge impact on your lifestyle, as well as how much you're going to need to get into the market.
Yeah, I think remembering back, I think people can't comprehend because they usually think about their local area. They know what prices go for in their local area. Even if you're a renter, you tend to know what prices go for in the local area because that's the area you want to live. But when it comes to investing, I know comprehending for me, Felicity and I lived in Elwood, beachside suburb in Melbourne. And in the late 90s, I was down there. And I think the median house price might have been a touch over $500,000. So for me, comprehending buying way out in the sticks in Bayswater was my first investment property for touch over 100 grand. There was a huge disparity of me comprehending that I needed to go out there, but that's all I could afford at the time. And so people being able to expand the horizon on where they're going to invest based on their borrowing capacity is probably an important thing.
Yeah, spot on. And also deposit, like how much deposit have you got? And also what are the options? And this is something that we get a lot of questions around as well. For people who might have part of a deposit, but not all of a deposit, should they get into the market sooner or later? Like wait until they've saved up the rest of the deposit needed to get into the market? And we're, I guess, really big advocates for exploring those options to be able to get into the market sooner, because we know if the market booms in the next 12 months, and let's face it, it's absolutely heading in that direction. If the type of property you were going to buy, let's say, was $500,000 today, and you continue to save to get from $40,000 to, let's say, a $70,000 deposit, in a year's time, that property might be worth $600,000 or more. And you haven't been able to save that $100,000 as fast as the market can make that $100,000 for you. Yeah. So I guess starting to think, well, what are the other options? Do you co-invest with your parents? Do you talk to your parents about getting an equity release or having them contribute to help you for a deposit that you can then pay back later? Do you work with, I guess, a brother or sister to get into the market, or are there other options altogether that help you to get into the market? Benefit from any market growth without, I guess, having to just work your butt off to build your deposit, in which case it absolutely will affect your lifestyle.
Early days when I bought my first property, I took advantage of mortgage insurance. So I got a higher LVR at 90%, I think it was back in the day. And I think it's one of the things that a lot of our clients ask is, paying mortgage insurance, it seemed to be a waste of money. But if it allows you to get into the market much sooner, or hold some money in your bank account as a buffer so it doesn't impact your lifestyle, or use that additional money for deposit of the next property, I think mortgage insurance is one of the best fees you can pay.
Yeah, and I probably just want to say to that as well, because I absolutely agree. If you can get in with a $50,000 deposit and control a property worth $500,000, as opposed to putting in an $80,000 or $100,000 deposit to control that property, you're obviously going to get in sooner. You're going to be able to hold more property. But it's really important that people also don't bank on that mortgage insurance in the future.
Yeah,
we're already starting to see with where the market's at, there's a fair bit of heat in the market. And potentially over the next 9-12 months, we might see those LVR requirements starting to change, meaning that banks will require bigger deposits from borrowers in the future. And that's just something we've seen, for instance, in New Zealand, where the market's hot, prices have gone up 20%. So if you think back a year ago, somebody could have got into that market with a small deposit and benefited from 20% price growth. Today, they would need, somebody entering the market needs twice as much deposit, plus the prices are also 20% higher. So it's like a double whammy. And that's because the market was so hot there. Their financial regulators trying to dampen demand a little bit to keep a lid on prices. So they're saying every bank needs to take a bigger deposit from a borrower before you can lend money to them. So that means that obviously those people that got into New Zealand a year ago have benefited from all that. And we're kind of looking at Australia in the same vein right now. All the whole mix is very similar to what New Zealand was seeing a year ago. There's structural undersupply in a lot of capital cities. There's really good affordability because of low interest rates. That's leading to prices going up. Rents are also going up because of the undersupply. And those that don't act now and wait, thinking, well, in a year's time, I'll have more deposit or I might be in a better position to do it. Well, in a year's time, you might have missed a really big opportunity and it's going to be harder for you.
Yeah. The concept of you need money to make money, obviously you need that deposit to get started. So the concept of growing your wealth is initially holding the most amount of asset with the least amount of money out of your back pocket in holding costs and deposit. So I think, like you said, at the moment, if you can take advantage of mortgage insurance, fantastic, because you can get into the market sooner. But the concept of only the rich invest in property, when I first wanted to invest in property, it was because I saw people who had wealth. The majority of the foundation of that wealth was residential property. The majority of people I'd studied early in my teens. But then as I've talking to more and more people and more of our clients, thousands of our clients, even if you think about the local demographic in the area I live in around here, a lot of the local school friends who have built property portfolios through our advice, the wage bracket they're on is usually around that of a couple of teachers, maybe a bit more. Do you know what I mean? So just using that as an example, one couple who are teachers in the local area have built a portfolio of their own home plus 5 properties. So, you wouldn't deem a couple of teachers to be rich. They wouldn't be the first people you say off the bat, only the rich invest in property. And I know you're probably similar, but when I started wanting to know more about property, I wasn't going into the equivalent of Melbourne's Wall Street and rubbing shoulders with high-end businessmen to find out about property. I was talking to people like your dad, who is fairly humble and kicks around in a normal everyday car and wouldn't be seen in the general eyes of the public as rich, the way he perceives himself. So I think people need to understand that people who have wealth and have built property portfolios are just like you and me. And so that, you're not driving around in the fanciest car. Obviously, your brother does, Al, but no. But obviously, the material external doesn't always equate to real wealth.
It's like the term "the millionaire next door." Most people don't know how much wealth the person next to you has, and most millionaires in Australia are just living in suburban areas in pretty modest houses. They just have a lot more comfort and what we call, I guess, what people might call financial security. And there's different layers, different levels of financial security. But most people, it's not about being flashy. It's about having that lifestyle, having the knowledge that you're never going to be kicked out on your ass. But I reckon 3 key things that people need to grow wealth, particularly through property, is knowledge, some capital, and time. Yep. And if I put them in order, I would say time is the most important, meaning the time in the market is the most important for you to grow your wealth out of property. The second most important is the knowledge. And the third most important being the deposit or the initial capital. And the reason I put them in that order is nobody can make up for lost time. So you can't catch up to that when you miss 20 or 30 years of market cycles. You can't catch that up. Secondly, if you've got the knowledge, then you need less capital to start with. And obviously, third, capital. Nobody can get in with zero capital or zero income. That would almost be impossible. But if you kind of work through how do you bridge the gap on each of these things? Well, as I said, you can't bridge the gap on time. You need time. And the earlier you can get into the market, the better. Secondly, knowledge. Other people have knowledge. You might not if you're a new investor, but other people do, and you can borrow that knowledge. So you've got people, experts who have done it before. And as Cam said, or as you said, Cam, you borrowed my dad's knowledge, as did I. And through borrowing that knowledge, it meant that me and my brother bought into the market in the late 90s when I was we were pretty much teenagers. I was 18 and Al was 20. And we got in with a $20,000 deposit to get into the market at that time, which we saved up 10 grand each doing part-time jobs. So that got us in, and we had lots of time since then. So that was obviously the 3 ingredients for us. We had a little bit of deposit, but getting in sooner rather than waiting for the market to boom, which it did over the next 2 years, meant that we didn't need as much capital as we would have had we waited. And it meant it was a double whammy. We got more time as a result. We also got more knowledge, and we had more capital by the end of that market cycle. So that's kind of the 3 real ingredients. And as I said, you can kind of bridge 2 of them. Also, the knowledge that you can borrow from others can help you to bridge the gap with a deposit is another way. Or the third way is to invest with somebody who's already got the knowledge and has a lower capital entry point so that you are in the market for longer, getting the time in the market and benefiting from the market growth, which is obviously one of those key things that we provide with Resi Fund, and why we structured Resi Fund in the way we did, so that people can invest with as little as $1,000, and they're investing across Australia's, their portfolio spread across Australia to benefit from the market growth. And I guess why when you talk to, when you read things by Warren Buffett, or you read things by whether it's Scott Pape, who obviously has a really good following in Australia, a lot of their advice to new investors is don't try to be an expert who picks one thing that goes up. Invest in the market. And they can obviously do that through like in the share market, but you can also now do that in property. And if you're like a lot of Australians believe that in the housing market, it's something you can touch and feel, you understand it, you live in it, obviously being able to invest in that and using somebody else's expertise and getting all the extra time that you get from getting in early, then that's obviously going to put people in a much better position than potentially waiting and trying to save against the market.
Yeah, it's a mantra held by majority of investors. I mean, Jan Summers, obviously, in the book talks about the time through cycles. Your dad 20 years ago when we were absorbing as much information out of him and his friends who were a group of investors. And one thing Steve used to always say to me when we were trying to, young 20-year-old kids trying to take on the world at that point in time, he'd just say, slow down, boys, time's on your side. You're going to get into the market shortly. It doesn't have to be this month. We were talking about we needed to buy this week. He's going, just calm down. We'll find the right property and then we'll move forward from there. And then when the market was heating up, man, he loves his saying, Steve, but when the market was heating up a bit and I felt like I was paying slightly too much, he'd say, like, overcapitalizing is like a bad haircut. Time fixes everything. So those old school investors really believe that time is the biggest draw card you've got as an investor. So you're right, putting it number 1 in your list there. Yeah, very, very wise. The concept of a passenger and a driver when it becomes an investing force. I know I was definitely the driver when it came to wanting to build a portfolio, and Felicity was the passenger initially. If you think of that concept, she's came on board and enjoyed the benefits from it over the decades now, and well and truly understands the benefit of investing in property as a couple and a family unit. But it was me who was pushing it along. There's no doubt about that. One of her biggest fears was, is it going to impact our lifestyle? Because we were both earning reasonable money as young kids, 20-year-olds. And then when she had Hannah, she was, we were reducing one income, but her knowing that the type of property I was sourcing was basically cash flow neutral, or just it was slightly negative at that point in time, gave peace of mind to the impact on lifestyle. You found that with yourself and Claire when you're investing?
Definitely. So when Claire and I first got together, I already owned a bunch of investment properties. I was still renting. And then this is where I guess having a plan is really critical. If you know what your goal is. For me, I wanted a good lifestyle. I was in my early 20s. And being able to go out on a Saturday night and spend some money, not having to worry too much about if I went on a holiday once a year, whether that was going to kind of break the bank. For me, that meant if I rent, and I lived with some other friends, so I shared with 3 other mates. So my rent was $100 a week through most of my 20s. And that meant that I never had that stress of just paying my own mortgage in a principal place of residence. If I lost my job, well, the tenants are paying rent for me and I'm getting some surplus cash out of those properties. So it never really impacted our lifestyle. Claire, when we got married, wanted to, I guess, have her own house to live in and hang things on the wall, and didn't want to have to go through asking for permission to have a cat, that sort of thing. So we were able to then make that decision to buy our own place and could do it comfortably because we'd had time in the market, and those decisions that we'd made along the way didn't impact our lifestyle. However, I will say that there was a limit. I always ensured that I covered my investments first. So if I had bills to pay, if there was an air conditioner I needed to repair or I needed insurance, that always got paid first. And I always made sure that I was saving after that, not going on my holiday and then coming home and going, how am I going to pay these bills on the property? And I had just a quick anecdote. Yeah. So sort of talking about lifestyle. So when I was 26, I went to Thailand with a bunch of my mates from a couple of my housemates and other guys I played footy with up in Brisbane. And when we were going to leave Thailand, there's an airport tax. None of us had ever been overseas. So we got through the check-in. We were about to go into the gates and the security guard stopped us to get our receipt for the airport tax. What are you talking about? Oh, it's 500 baht or whatever it was, which I think was about $10 Australian. And a few of the guys, there were 6 of us, stuck on, do you guys have any money? Like, I ran out a few days ago. Like, who's got money? So I had to go to sort of the bank, transfer some money out of one of my investment property accounts, take the cash out, give it to the guys to get through. And turned out that one of the guys in particular had stopped paying his phone bill 3 months earlier. So he had enough money to get through Thailand. He ran out of money a few days before the end and started borrowing from the next, like one of our other mates, who subsequently ran out of money as well. And I was like, mate, you're living on borrowed funds. Like, why did you commit to this holiday if you couldn't even afford to pay your phone bill? But I think that's, an approach a lot of people take, is that they're scared to miss out. That was the case then. He was like, everybody's doing something that I don't want to miss out on it. And I'm sure he's really rapt that he managed to get through that holiday, fortunately, because he had some mates who could give him a chop out. But I think that's a real key difference. Like, investors and people who know what their goals are and have a plan, you invest first, you make sure that you're setting aside money for the investment, and then you obviously, for me, I allocated money to go out and have a good time after that. And the longer you invest, the easier it is to have money to be able to do those things. And it's probably just a different mindset.
Yeah, I think it's a mindset. I think every investor needs that delayed gratification. So you sacrifice something today to have something much greater in the future. I know Al, your brother and our business partner, when he was investing initially, he couldn't afford to travel overseas because he built up a base portfolio of properties. And one of his friends said to him, well, at least I'm going to have the memories from going overseas. Well, now they're still working, and he goes overseas 3 times a year and has 4 months off and spends all the time with his family, and took 3 months off the year before COVID and traveled through America. So that delaying gratification back then has meant that he's going to spend the last 40, 50 years of his life really living the dream. And I think that's what people can't comprehend, is they're so worried about, and use the smashed avo analogy. I never went to a cafe until I was probably 25. You know what I mean? Whereas my 14-year-old daughter goes out and has smashed avo with their friends nowadays. So the amount of money that's being spent on a daily basis by people in today's society is so much greater than, when we were younger 20 years ago. So it's phenomenal if you think of the amount of spending going on today, especially the online spending, compared to 20 years ago. I was still in the back end of the generation that used to get their pay slips in a yellow envelope each week, and you'd have your cash there. And I would do the same. I'd walk down to the bank and put all the money I needed for my bought properties into the bank, and I'd be left with, and that's what I had to spend for the week. So it was a nice, easy way. But
Well, and if anybody's looking to save up a bit of extra money to bridge the gap on their deposit or improve their serviceability for their borrowing capacity on the loan, I can't get Uber Eats in Brisbane for lunch because there's not enough Uber drivers around here. So if anybody's looking for some extra cash that lives in Brisbane, get on the Uber Eats app and start driving your car around, because I reckon there's a fortune to be made there.
It is. It's probably one of the last things I want to cap off. And I know that we talk about Resi Fund a lot, and it's a fund that we created a number of years ago. It was probably about 4 or 5 years in the making before that. And you obviously run Resi Fund, and it was because there was a real need for people wanting to get into the property market who couldn't afford it. And at the back end of it, OpenCorp helped thousands of people build property portfolios, but there's a huge amount of people that can't afford the deposit. And then at the back end, there's a lot of people who are asset rich and income poor. Do you want to give listeners a quick snapshot on what Resi Fund is, why we created it? And because one of the biggest questions we get asked is, I've got $10,000. What do I do with it?
Yeah. Okay. So Resi Fund is a fund that owns a property portfolio around Australia, and that owns a property portfolio of residential properties that generate rent. That's the purpose of owning it. So it's cash flow positive. So people who invest in Resi Fund get a distribution every quarter from the surplus rent, and they get benefit from the market growth. Now, we also, obviously with our expertise, able to go and add value to properties here and there, but also give a boost above market return. And in the last 12 months, we got a 12.5% return when the Australian property market, I think the total return was sub 5%. So we well and truly beat the market over the last 12 months. The year before was over 10% as well.
Now,
so
with our Australian Financial Services license, past performance is no indication of future performance. But yes, that
spot on. You're investing for the future, not for the past. But obviously the things that we do to try and that have benefited the fund in the past, we continue to do into the future as well. And so essentially somebody who's investing in that fund is getting access to what would ultimately be what most sophisticated investors would be trying to structure, which is a portfolio with houses or properties around capital cities around Australia that are generating really strong rent, that are diversified by tenants. And therefore, and also because it's got low gearing, obviously the risk profile is low relative to buying one asset and gearing up to the absolute hilt to get into that one asset. By getting into it early, it means that investors can have a regular savings plan, that putting money into the fund means that you're acquiring a bigger interest in the fund over time, as well as getting the benefit from the distribution, so that it helps to grow your deposit, get you closer to being in a position to buy your own property. And if the market booms, well, your savings that might be in Resi Fund are getting the benefit of that growth in the housing market. So it's really making sure that you don't fall behind the housing market and you're benefiting from that, as well as our experience and knowledge and our networking that helps to acquire, I guess, properties that we aim to beat the market with. So, yeah, I think it's something that's very unique in Australia, which is why we spent so long working on it to get it right. But it really just borrows from all the best things that we've done in our investment journey to put it in a place where somebody can get access to that with a lot less money than what would be needed to start in the property market yourself.
And we can't provide, with our fund, obviously our financial services license allows us to talk about the fund. It doesn't allow us to talk about what an individual should do or should they invest in the fund. That's their own decision. Yeah. But the type of investors it was created for was, like you said, people who are trying to build a portfolio and don't want to get priced out of the market, so they can have their money within the property market and allow that to go up while they're doing that savings. But we've also found that a lot of people who are clients who build property portfolios with us, while they've got a bit of equity, they're trying to get to that next property, they like to have that cash that they've got sitting in the bank, that they're saving a lot for the next property or the third or fourth property, have that within Resi Fund. And we found that being probably an area that we didn't realise would be so much of an interest in investing. The back end of it, Matt, because a lot of people get to the stage of life. I mean, I'm nearly approaching 50 now. And while I'm not thinking of retiring anytime soon, I know I talk to a lot of people who are asset rich and income poor, who might have 3 or 4 properties, but can't see how they're going to retire because they aren't able to draw enough income from those 3 or 4 properties. What's an example that they could use to utilise Resi Fund?
Yeah, so we did do a webinar with a financial advisor from Sequoia, which is a big financial advice group last year, that actually looked at this, and it runs some examples of what happens if you were to sell down some of those properties where you might have debt and you no longer want to have debt, you want to have a bank mortgage anymore, and converting your equity into cash and investing that into Resi Fund, either through a self-managed super fund or personally, and then being able to draw an income out of Resi Fund. So staying in the market where Resi Fund continues to grow its assets. So you're benefiting from all the work that we put in, but the investor doesn't need to have a mortgage themselves and gets the positive income that's coming out while the actual asset base is growing as well. So it's probably, rather than me going into too much detail today, we can provide for anybody who's interested, can provide a fairly detailed webinar on exactly that. And what's the best email to shoot through if somebody is interested in that, Ken?
Probably warren@resifund.com.au.
Yep, spot on. So if anybody's interested, if you're either a self-managed super fund operator or you're positioning to retirement and you want to look at how could Resi Fund, I guess, play a part in that transition to retirement for you, shoot an email to warren@resifund.com.au and we can provide a copy of that webinar as well as any information you'd like about Resi Fund.
Perfect. I'll wrap things up, but there's a webinar we're holding on the end of April. People can go on the OpenCorp website and have a look at the dates or register for that. But we've actually specifically tailored this one about using a process called the knockout rounds, which is something that I've believed in for many, many decades. There's so many investment choices thrown at you, and especially when the market heats up, it seems like there's just an overload of white noise out there of different options and people talking about property. And it gets confusing. People often get analysis paralysis and don't invest and miss out on the market growth. So the knockout rounds is a process we use to look at different investment options. It's a process of elimination. So we compare different investment options, knock them out, which gives you a final clear strategy. So that's the end of April. We'll be running that webinar. I think it's the last week, but people can jump on there and go through that. We'll really outline how people can cut out the white noise in investing nowadays. But Louis, I'll leave you to it today. I know you've got a bit on. How's the rain up in Brisbane at the moment, mate? I know half the world's getting washed out around Australia.
Yeah, it's been, I think, the monsoon season. So it normally ends around the end of March. I love it. I watched the other day, there was a storm coming over the city. I saw about 100 lightning strikes in 10 minutes and then stopped counting. But I enjoy it. The kids don't love getting wet feet on the way to school, but we've got a good dry spell coming after this. And it certainly hasn't stopped people from getting out around Australia and going to auctions, which, I think is an indication of how the market's going right now.
Yeah, true. I know Sydney, they obviously had a fair bit of rain over the last week and they were 94% clearance rate. So people were still out in their boots on the ground, gun boots on the ground. And we've got the OpenCorp Client Day this weekend on Sunday at the Taronga Zoo. I think we've got about 300 families going along there. I think it's going to clear up. Should be a good day. We've still got a lot of people ready to throw the umbrella on if needed, but I think we should be right. So it'd be good to catch up with our clients.
Spot on. All right. Awesome chat, Cam.
Good to talk to you. Take care.
Yeah.
The information featured in this podcast is general in nature and may not be relevant to your personal situation. You should seek advice from a licensed professional before making any investment, insurance, tax, property, or financial planning decision. Guests appearing on this podcast may have a commercial relationship with the companies mentioned, and opinions and views expressed may not reflect those of the Smart Property Investment Network.